Hi there, welcome back. Thanks for checking our social media. Please leave your likes, comments, so we know the type of content you like to see in our future releases. Today we're going to break down the 5 common mistakes that many first-time homebuyers make during the process. Please stay tuned and let's go over them. The first mistake that many future homebuyers make is thinking about the down payment and how much is needed to make it happen. Many of us, we were told that 20% is the key number, is the magic number that should be used to pay a home. Yes, despite this 20% is most commonly used figure, like to say, buy a home and get a mortgage approved. For first-time homebuyers, there are other programs that make it possible. And in Canada, you can go for a home, for your first home, with as low as 5%. That means that for a $500,000 home, instead of $100,000, that is 20%, you'll need only 5%, that is $25,000. That is quite significant difference between these two figures, and that may help you to get closer to it. But don't forget, if you go with a 5%, or anything less than 20%, you will also be charged with the CMHC insurance. That is a system in place in Canada to pay in case you default your credit in the early stages when the equity could be lower than the debt. So yes, it's possible. Yes, it's there for you. A home can be bought with less than 20%. The second mistake that many future home buyers make is not checking their credit score. Sometimes they apply for credits, they have many credit lines, credit cards open, and they don't check their debt to income ratio, or they keep also a very high credit utilization. This may affect their credit despite their being good payers. Will a bad or lower credit score stop you from getting a mortgage approved? No, you might get it anyways, but the difference is that you will get a higher rate. A higher interest rate will result in many thousands of dollars that you will be paying along the life of your mortgage. So having a better credit score will result in you paying way less money and making your life easier as a mortgage debtor. On top of paying your debt and having your credit lines not maxed out, for example, if you have a $10,000 credit card, not having it racked up to $9,000, $9,500, but keeping it below the 50%, it is important for you to check your credit score 5 to 12 months ahead of the purchasing of a home. That will give you time to put things in the right place, maybe lower the balance of that credit card that it was a little bit higher, or check with the creditor about that inconsistencies in your information report that is not accurate. You don't want to come to the moment when you found the right place and then you have the down, and because there's something in your credit card that is not right, because you either didn't prepare yourself, you didn't request it to be fixed, then you can get declined, or at the end be paying a higher interest rate, because a bad credit score might not prevent you from getting a mortgage approved, but might result in a higher interest rate and many thousands of dollars along the life of your mortgage. The solution for this is an easy one. Don't max out your credit lines, pay on time, and 5 to 12 months. Check your credit score closely and keep an eye on it so everything is as expected and you can get the best rate. Now let's get closer to the moment. You got the down, you have an idea of what you want to buy maybe, and then you start watching for homes and before getting approved. Doing that is like putting the horses ahead of the cart. Watching homes before getting your pre-approval might set you to two possible scenarios that I've seen many times. The first one is that you watch the house that you want, you have the capacity to pay, but you're not pre-approved. Then another buyer in a hot market puts an offer. By the time you get your approval that you can make an offer, it's too late, the house is gone. So the house of your dreams, the perfect place, is gone. There are many homes, yes, but each one is unique and maybe that one won't show up again. And the other possible scenario is that you can get disappointed because you were trying certain targets, certain type of home, and it happens that you get approved for way less money and you are not able to afford it, and that might hurt your feelings. It's important for you to check with a licensed mortgage broker about your pre-approval and how much you're gonna be allowed or you will be borrowed. With that in mind, you can then jump into the market and watch for homes. That's an easy one. Then the following common mistake that many future home buyers make: skip the home inspection. And skipping the home inspection is one of the most silly mistakes that you can make. The house could look great, could be just built 1 or 2 years ago, have that perfect flooring, just renovated, beautiful countertops. It's a dream of a house, right? And then without the home inspection, you don't know that it's a leak, it's a cracked foundation, it's a defect that is out of warranty, and you're not covered, and you enter yourself into a nightmare. Home inspection as well as financing conditions are there to protect you, to let you run away from a bad business or something that you will regret. If you ever consider buying a home, no matter how hot the market is, no matter how great the deal looks to you, you must go for the home inspection. And only after getting a detailed report from a licensed home inspector, you will be able to weigh the conditions, knowing what you're buying. Because you know, maybe you could go then for contractors or for specialists to give you a quote and decide if this is a good investment. So easy, don't forget it. Home inspection must happen. Another common mistake is that once you got your pre-approval, you already placed an offer for a house and everything seems to be rolling as expected, and we go out for furniture and we buy $20,000-$30,000 in furniture for that new home. Maybe you can buy it, you can do it, but making such a big expenditure on credit could be a big mistake, because lenders will be checking your credit score permanently up to the closure of the deal, and anytime they can hold the process if they see major flags. For example, buying a new car, buying a lot of furniture, spending big on credit cards for a trip. They might say, oh no, now the debt to income ratio for this person changed and now we cannot give them as much, and that can put you in a lot of complications. The other thing that you should also be aware is that don't change jobs. Once you get pre-approved, I would say things should be where they are. Nothing changes, nothing up, nothing down. You were approved with this set of rules, with this situation, and you don't want creditors to be reviewing it again and again and again. Only after you got possession, everything was set on stone, and you have your title in your hand, then you can go for that trip or buy the furniture or change your car. If you're capable of paying that and handling the debt, it's up to you. These are the 5 big mistakes that many future homeowners make and might derail the process. If you keep them under control, if you follow the instructions of your realtor and your mortgage broker, you might be closer to achieving your dreams of home ownership and also securing your financial future. See you in the next one. Please like, click comments, and let us know about the type of information you'd like to know or discuss in further. See you. Bye.